Hi friends, if you looked at the commodity market this week, one asset completely stole the show, silver. While the mainstream headlines were focusing on daily stock market volatility, silver quietly broke through the major technical resistance, leaving retail traders scrambling. If you only watch daily market noise, this might look like a random pump, but it is not. In fact, what happened this week is the result of a massive structural imbalance that has been building up behind the scenes for over 6 years. Welcome back to the channel. Today we are breaking down the big move in silver, the exact macroeconomic triggers, the hidden industrial supply crisis, the technical chart levels, and most importantly, how you can approach a setup like this without getting caught in a trap. To understand why silver moves twice as fast as gold when it finally decides to break out, you have to understand the two faces of silver. Gold is purely a monetary metal. Silver is half money, half industrial workhorse. And right now, three massive catalysts just lined up simultaneously. First, the green energy demand trap. Over 55% of all physical silver used globally is consumed by industry. Solar panel manufacturing, electric vehicle circuitry, and now high-speed vehicle circuitry and data center connectors rely heavily on silver because it has the highest electrical conductivity of any element on this earth. Solar installations have alone doubled their silver consumption over the past few years. The demand is what economists call inelastic. Manufacturers buy it regardless of whether the silver is $25, $50 or $80 because they need it to build their product. Second, the byproduct supply crisis. Here is what most investors miss. You cannot simply build a silver mine to increase supply. Roughly 70% of global silver output comes as a byproduct of lead, zinc, copper and gold mining. If copper mining stalls due to global supply chain slowdowns, silver production drops too. No matter how high silver prices go, we are currently living through the sixth consecutive year of an absolute structural silver market deficit. The physical vaults in London and New York are literally draining to meet daily industrial needs. Third one, the gold to silver ratio compression. Historically, the gold to silver ratio averages around 50 to 60. When gold rallies to a new high, silver often lags behind initially, but when the gold-silver ratio gets stretched too far, say upwards 80 to 85%, the market corrects arithmetically. Silver catches up violently to realign with gold. Now, let's step away from the fundamentals and look at the chart because the price action gave us exact clues before the occurred. On the weekly time frame, notice this multi-month base. Silver was cooling inside a classic ascending triangle. High volume kept defending the 50-week moving average, showing strong institutional accumulation every time retail traders panicked during the dips. Now look at the daily view. We had a key resistance level sitting right here at $32 or any local high. Notice how three previous attempts to clear this have collapsed because of low volume. But look at this candle right here. First one, volume spike. Volume was 2.5 times higher than the 20-day average. Number two, clean body close. The daily candle did not just touch the resistance and wick down, it closed above it. Third one, short squeeze acceleration. Once the level broke, automated short stops were triggered, forcing paper traders to buy back positions, accelerating the green candle. This is a textbook breakout pattern created when physical supply tightness meets paper market short covering. So, how should a disciplined investor or trader actually handle a move like this? Here is where 90% of retail traders lose money. They see a massive green candle on the news, get FOMO, and buy right at the top of the spike, just as early buyers are making profit. Here are the two ways to approach the setup logically. Strategy 1, the retest rule. It's for traders. Never buy a breakout extended far above its moving average. Patient traders wait for a reset. You want to see price pullback to test the old resistance level to see if it actually acts as a new support. If it holds on declining self-volume, that is your low-risk entry with a tight stop loss below support. Strategy 2, dollar cost averaging. If you are playing the multi-year macro deficit theme, stop trying to time 5-minute charts. allocate a fixed position size over time. Keeping in mind the silver is notorious for its high volatility. It can drop 8% in 2 days just to shake out weak hands before making its next move. Remember, position sizing is your real protection. Never leverage into a high beta commodity. The big takeaway this week is clear. Short-term price swings are often driven by paper speculations, but long-term trends are dictated by physical supply and demand. And silver's structural deficit is not disappearing anytime soon. What's your plan for this commodity move? Are you holding physical metal, trading ETFs, or staying on the sidelines? Let me know in the comments down below. If this deep dive helped you understand the market better than a 60-second news clips, hit the like button and subscribe. I'll see you next week for our next big move breakdown. Thank you. Take care.